Hi, everyone. I'm here again with my good friend Saket and my good partner. We're just going to follow up on the previous recording, and I hope you all enjoy our little bits of information about what it means to be an investor in multifamily apartment building. So, Saket, I just want to focus this time on explaining a few things about what is a multifamily syndication. Most people think that it's a weird term and means multi-level marketing or network marketing or something like this. And I want to make sure they understand what is a syndication and what are we referring to of being a multifamily syndicator.
Yeah, definitely. So I think let's look at the word syndication itself, right? What does a syndication mean? Syndication really means a group, right? So when we say let's syndicate the risk, that essentially means let's bring the group together so that risk gets divided. So syndication is really, when we talk about multifamily syndication, it's really a group of investors coming together to buy an asset. In multifamily case, it's usually an apartment building. It could be class A, class B, class C. So that's really, in essence, a multifamily syndication is. Now, let's take it one step further. When we talk about multifamily syndication, if a group of 100 investors are coming in, imagine if there's nobody leading that group, right? If there's nobody sort of making decisions, because if hundreds of investors are coming in, there's never going to be a cohesive decision that everyone's going to like, because everyone has different motivations, different level of understandings. So what happens in a multifamily syndication is there are self-identified group of folks, a team of members who are called sponsors. They take on that responsibility to actively manage the asset. So the
They're
day-to-day
also called
activity.
they're also called general partners,
Correct.
GPs, right?
Sponsors, general partners, these are the terminology that you usually hear about them. So they are the guys and gals who are managing those assets on a day-to-day basis. They make the decision, they make the purchase decision, they make the disposition decision, they make all the other decisions that are required to make sure the value is added to the apartment. And the investors are still partners in the deal, but they're called limited partners. So their role by definition is limited, right? Where the most active decision as a limited partner you're making is, do you want to invest in the deal or not? That's really the most active participation required from you, because we want to make sure that you've done your due diligence, you've run your numbers, you have done checks on sponsors and all that good stuff, what you need to do. And once you make the decision, you could decide to be actively involved, but you don't have to be, right? And when we say you can decide to
Right.
be actively involved, we're saying that you can be actively involved in the perspective of, hey, I want to be on a property management call. Hey, can I talk to you when you guys sync together on a weekly, daily, monthly, whatever the schedule, your cadence is? Can I join those meetings? Can I be a fly on the wall and listen in? But I understand I don't necessarily have any authority or responsibility to make any decision. So
Yeah, and
that's really in essence.
I also would make a little note here that limited partner means in terms of limiting their responsibilities too.
Yeah.
They're not partners that are signing on the loan for the property. They're not partners that are responsible for any kind of due diligence or guaranteeing any kind of loan or amount of money. They're just investors that are limiting their responsibility to basically contributing to raising the capital to be able to purchase that property. So there benefits and I would say responsibilities of being a limited partner, but I think we cover pretty much what the limited partner is, right?
Yeah. No, I think you're right. I think that's in a sense, of course, like anything else in life, there are nuances,
Yeah,
and every deal is structured different. Every deal has to be reviewed differently. But from a conceptual perspective, that's really what a syndication is. And there are two
yeah,
main actors in that process: a limited partner and a general partner. So hopefully, this provides some clarity on how to look at
right.
syndications.
Now, another thing that we are asked, pretty frequently is like for someone who wants to participate in a deal like this as an investor or a limited partner, What do you think the risks of being a limited partners are? Like, can we kind of narrow down what are the risks? Because people are concerned about putting a certain amount of money in a multifamily real estate business, and they don't know what to expect or what the risks are or how
Yeah.
they can manage that risk benefit ratio.
Yeah, so I think let's look at that perspective. There's really two categories of risks, right? When I look at it, so and I'm still a limited partner in multiple deals, and I'll continue to do that. So when you look at the risk, there are two types of risk. One is a financial risk, the other is non-financial risk. Let's talk about that. Financial risks are easier to understand because you're making an investment of 100, 500, a million, whatever amount you're investing in a deal. There's always a potential that the deal may not perform. Right? That's a risk that you're. It's like buying an Apple stock. You're not guaranteed that it's going to return, but you're betting on the jockey, which is Tim Cook in this case, before it was Steve Jobs, that they will make the right decisions for the company to make sure your returns are met, return expectations are met. So, but that's really a projection. You don't know what the actuality may be very different, right? Which is exactly same. And when you're investing in multifamily or any other investment classes, you go in with a thesis along with your sponsors, along with your general partners, to make sure that you all feel comfortable with what the business plan looks like. Right? But there is a likelihood. In some cases, they're high likelihood. In some cases, they're low likelihood. So the probability of something materializing is different in different deals because it all depends upon what assumptions were made and what level of risk exposure is there. But you have that risk that your capital may not return the amount that it was expecting to. That's like at the
So that's a financial risk,
the
right?
financial risk, right? And
Right.
of course, you have to also think on the flip side of that is the advantage of that is that you're going in with an educated guess to make sure that you're comfortable with. If somebody says the rent growth is going to be 50% year over year in the next 5 years, you already know that deal is high risk, right? Of course,
Right.
everyone knows that right now. But if there's someone who's going in that my projection is the rent's going to increase 1% for the next 5 years, that likelihood of that happening, very high, right? Likelihood of you not meeting the expectation of 50% rent growth. I'm using an extreme example to make a point.
Right.
The chances of that happening are very slim. So you're buying in, the risk is there on both deals that the projections may not be met, or one, it's significantly higher than the other. That's how you want to look at the financial risk.
So what would be some of the non-financial risks
Yeah.
that
So when you're
we're
talking
talking
about
about?
non-financial risk, right, you're really thinking about, if I'm an investor, what's my liability exposure? I think, Tudor, in your profession and your set of investors is actually important because most of them are most of the doctors in the medical field, right?
Right.
You're already exposed to so much liability as a medical professional that your biggest thing is, while I'm putting this money in $100,000 of my money into a 100-unit apartment building, and what if somebody sues the apartment? What happens to me?
Yes.
It's important to know, by definition, you're a limited partner.
Correct.
That means your liability is limited. That essentially means it's actually not even, I think the word limited liability doesn't exist. It really means that if somebody sues the apartment building, you have zero liability exposure. And there's actually a podcast that I recorded with one of the securities attorney, Mauricio, and we actually go deeper into that same specific topic for the same exact reason, because we wanted to make sure that they're hearing not from Saket, they're actually hearing it from a legal professional who does this thing for a living, right? So as a limited partner, you have zero liability exposure, additional liability exposure than you already may have. Like your profession as a doctor may already have tons of liability exposure, and that's a separate discussion. But adding on an apartment building to your investment portfolio as a limited partner does not expose you to liability beyond what you may already have.
Yeah. And to segue now from this point about liability, what would that be translating into the profits of the deal? Because we know, general partners have their share of the profits, and the limited partners are sharing the other part of the profit. So
Yeah.
let's kind of clarify, how is that translating and what the general partners are profiting from this deal compared to the limited partner. So everybody knows what are the differences between being a general partner and being a limited partner.
Right. So I think the biggest thing to understand really is no one's doing this as a charity. Nobody is, and nobody should, right?
Right.
So when the sponsors are coming in together and they are spending their time, their resources, and they're putting their money at risk. And Tudor and I have a lot of scars from those losses,
and their liability
and the liabilities, right? Yeah.
right
So when somebody is taking on that amount of risk, and spending the time and resources that are scarce, they want to make sure that they are looking at the upside, that they're going to get paid, right? Now the question really is, how do they get paid? So there's really three ways that a sponsor extracts value for themselves from a deal, right? And if done correctly, it's the method to get rewarded, financially rewarded from a deal as a sponsor, is an alignment with the interests that our limited partners have always.
correct.
So let's talk about that. There are three components. So there's a portion of the money that gets paid upfront. There's a portion of the money that gets rewarded in the middle during the deal. And then there's a portion of the money that gets rewarded at the disposition, which is the sale of the deal. So these three broad strokes. Now let's go deeper into that. So
how much usually have we seen in terms of percentages on a deal that general partners are making?
Yes, I think let's answer that question before in a second. But let's go through these three components, right? So the component is when you're acquiring the deal, when somebody, like, let's say me, I'll find a 100-unit building, and Tudor, you're investing in it. A portion of whatever you're contributing is going towards a fee, and the fees are acquisition fee. Now, every deal is different, so not every deal is going to have all the different fees, and not all the numbers will look the same. So there's acquisition fee, there's loan guarantor fee, there is finder's fee. There's so many different varieties of fees. There's essentially a sponsor is saying, and this is all disclosed up front, so they're not hidden from anybody. They're disclosed. So we're
Correct, and
basically
they're
saying
taking into the underwriting calculations of the projections.
your projections are already net of all the fees. They're
Right.
telling you what that would look like. Now, the second bucket is the middle portion. While you're holding the deal, there's something called as an asset management fee. So that fees is usually, for the apartment complexes, is usually calculated on rents collected. So if you have a $71 million apartment and you're bringing in $1 million of rent, so the asset management fee is going to be a percentage of the rents collected, not on $72 million, right? Again, every deal is different. Every sponsor is different. So you want to understand the nuances of how it's calculated. And then the last is the disposition fee, where they're saying that when we are ready to sell it, there's a lot of work involved. Most people don't understand it if you've not gone through this transaction. There's a lot of work involved, working with the brokers, getting everything ready, making sure the financials are clean and ready from a different buyer's perspective. I mean, we're very diligent with all the financials, but it has to be at a different level when somebody else is buying your building. So you have to make sure it's all done. So there's a lot of work. So the sponsor wants to get compensated for that as well. So these are the three broad buckets. To your question about what are the percentages that we have seen on an average, it's actually a complicated question, but I'll give you some high level averages.
Just very broadly to give a perspective.
So the acquisition fee, the upfront fee varies between 2 to 5%. And when I say varies, you have to pay attention to that. That does not mean they can charge you 10%. So it could be as low as 2%. It could be as high as 5%. It could be 7, 8, 10% as well, because if the deal is very complicated and they were acquired in a specific way, there may be a reasoning why the sponsor feels that they need to get rewarded a higher percentage. Usually it varies between 2 to 5%. Now, the asset management fee is somewhere between 1 and 2%. Right? All these fees are very reasonable once you start looking at them. The last component is the profit sharing when you dispose it. That's really where the bulk of money as a sponsor will make, right? So they're waiting till the end. If you think about it, if the deal has to be held for 5 years, the biggest reward that a sponsor will get is at the tail end.
Correct.
And that's when I meant that the interests have to be aligned, right? So let's think about the tail end. The tail end is if they bought a deal for $71 million, and let's say there is $100,000 of profit left. Hopefully it's going to be way more, but we're simplifying the example here. So a portion of that $100,000 is going to go to investors, and a portion of that $100,000 is going to come to the sponsors. Now that's now getting very complicated on how deals are structured. But a simplistic way to look at this is 80-20, 70-30, 90-10. Now, what it really means is 90% of that $100,000 goes to the investors and 10% goes to the sponsors.
Right. So now let's focus a little bit on the biggest part of the profits, which is for the investors, for the limited partners.
Yeah.
So let's say that portion would be 80%.
Sure.
And 20% for the general partners. So as an investor, as a limited partner, if you put a certain amount of money into the deal, let's say $100,000,
yeah,
what would an investor expect out of this investment if they have 80% of the profits from the deal?
Yeah.
So, describe a little bit of, what the cash flow part is, what the profit sharing at the end is, and what is the expectation for an investor out of a deal.
Yeah. So again, it's very market dependent. So let's talk about the current market, right? In the current market, you're looking to, at the end of the deal, you're looking to somewhere between 1.7xing your money to 2xing your money. What that really means is, let's simplify it. If you're putting in $100,000, we're projecting to make you either 170K back or 200K back. That's really the average. Again, none of this is certain. Every deal is different. Some deals have higher risk, so the returns may be higher. Some deals have lower risk, the returns may be lower, right? But this
so in other words, right, the $100,000 that you initially put in will be returned to you, plus a profit of whatever the X amount number is, correct?
It's not like 1.7, you're getting your 100K back and you made 70K on top of it.
Correct.
That's the 1.7. So you multiply the number of your amount of your investment by that number. If you're doing $1 million, it'll be $1 million back and additional $700,000 back to you, right? That's really what the multiple stands for. Now that multiple is an interesting number. You have to break it down further. That multiple has two components, right? So, we were talking about the previous episode about net operating income and cash flow. So if the cash flow is positive, that's not if, we're buying because the cash flow is positive.
Exactly.
So because the cash flow is positive, the key question is, what are you going to do with that cash flow? Do you want to just let it sit for 5 years, or you want to give it back to your investors, right? Well, we make a determination on a month by month and sometimes quarter by quarter to make sure that does that distribution need to happen, or the markets are changing and we need to keep some reserves. But let's assume everything is fine and we got $100 income, net cash flow. 100 seems low. Let's say $100,000 of net positive cash flow coming in. Now that cash flow also gets split in a certain prearranged number, 70-30, 80-20, right? Some just keep it very simple and say it's 80-20 all the way, which essentially means anytime there's a cash distribution, it could be because of the profit at the tail end, or it could be the positive cash flow during the time we hold the deal.
Yeah.
So that gets distributed 80-20. So let's just simplify the example for now.
Right.
So you get 80% of that $100,000, and then at the tail end of the profit, if there's $1 million profit, you also get 80% of that. Right? That's how you want to calculate the 1.7 or 2x. Now the key thing here to notice is if 100% of your money is coming out of profit, you want to dig deeper into the deal, because what is at least at the onset. Now, while you're holding the deal and a COVID happens and interest rate shoots up, nobody could have predicted that, right? So that is a reasonable expectation that nobody can predict it. But if you're thinking of from a stable environment, if only 5% of your returns are coming from cash flow and 95% of the remaining is coming from the profit, that deal may be evaluated strongly, because what we're saying, when I'm saying that, usually there should be enough meat on the cash flow that it's giving you more, close to 30 to 50% of your returns are coming from cash flow.
Correct.
So now, and the reason for that is, if everything is coming off of profit, that essentially saying that you're going to add so much value to this apartment that you're going to double the investor's money just by adding value to the apartment.
Yeah.
This market, it may not be that easy anymore. When the interest rates are 2%,
Right.
3%, there's a very high likelihood of that happening. But now, given where we are in the business cycle, that may not be entirely true. But I'm not saying it's impossible. That's really where you want to look at, right? Those two are the numbers.
Yeah, and it's also a little comment to make here, because most of the deals that we are doing and we're specializing in, they're value add deals.
Mhm.
So we purchase a certain apartment building that we are improving a lot for the community and for the tenants. Therefore, we're creating better living conditions. You are able to increase the rents. People are happier. Families are together, and they call it home. And they're staying in those apartments for many, many years. So this value add type of deals are creating a lot of opportunities, not only for the communities that are involved, but for the investors too. Because at the end, like you said, some of the profits are coming from straight cash flow during the years, and a lot of them are coming for the profit sharings at the end when the deal is sold.
Correct.
Now I wanted to, because we're addressing this webinar mostly to professionals and medical field professionals, I wanted to touch a little bit of like, what are the implications for being a passive investor in multifamily syndication in terms of tax advantages for an investor like that? Because, as you know, we're mostly very highly paid professionals that are trying to invest their money in this type of deals. And we want to know, what can we do about our tax planning? So let's deep in a few steps that we can count on in terms of tax strategy.
Perfect. I think there's a very detailed answer to that available on one of my podcasts. It's by Amanda Han on Migrate to Wealth. If you look for it, you'll find it. But I think just summarize to summarize the answer within the time constraint we have. It's really, there's two types of tax savings, right? One is you want to reduce your current income tax, what you have. That's one way to look at it. And the other way to look at it is, I may not have a whole lot of lever to pull to save my current taxes, if it's, let's say, 20, 30, 40%, whatever it is. But any additional income that I'm making through investment, I want it to be tax efficient, right? So we'll address both of them for a sec, for now. Let's address the latter first, which is, real estate is one of the top tax efficient vehicle that's available, especially given the risk continuum where everything falls in. So that, what that really means is, one of the biggest advantage of real estate is the depreciation, right? And of course, the deal has to make sense. The numbers have to make sense. Do not ever, 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 ever buy a deal just for taxes.
Correct.
I can't stress that enough. You'll see that usually in November and December timeframe, people are frantically deploying their money because they just want to save taxes. They don't even care what the deal is about, right?
Yeah.
You don't want to get in that situation. So you want to plan ahead. And Tudor and I have enough experience. If you need someone to talk to, we're definitely available to discuss that. But to answer your question, Tudor, is when we're looking at tax savings at the tail end that I may not have. Sorry, let's talk about depreciation. Because the biggest component of depreciation, the question that we need to ask is, how do you use depreciation? So depreciation, for those of you who don't know, depreciation is a concept which essentially means, what's the life of anything, right? So let's say you're buying a car. A car usually has a life of 5 to 10 years. So after 5 to 10 years, the IRS deems it's not usable. Now you may be able to stretch it out just fine. So IRS does the same thing for buildings. So when you're buying a building within itself has components that have a certain life, like a refrigerator has 10 years, maybe carpet has 5 years, drywall has certain, every component in the building has some value, right? So Iris is saying, we recognize that at some point you'll have to invest more into the building to make sure it stays up to date and livable and habitable and all that good stuff. So they allow you to depreciate the building on a certain schedule. A very
Right.
simplistic schedule is 27.5 years. Now, I know this is not a depreciation webinar, but really what you're basically saying is I bought a building for $27 million. We're talking about simplistic depreciation, where my life of the building was 27 and a half years. So roughly about $1 million I can write off in paper loss for owning that building.
Yeah. So this is one point I want to make here. Like you said, depreciation that a passive investor can take on its, for their tax planning, it's a paper loss that they can use against their whatever income it is. And obviously, everybody needs to consult with their tax advisor, but there's some options that we have as a passive investor and medical professionals to take advantage of those avenues in terms of tax planning. So let's kind of categorize how we can take advantage of those things.
Yeah.
One would be depreciation, like you said.
So depreciation, in essence, depreciation can write off, depreciation in a real estate can write off any passive income that's being generated by default.
Right.
Which essentially means, let's say, Tudor, I have a laundromat franchise, and you as a medical doctor invested $100,000 in my franchise, and you're a limited partner in that franchise, and that franchise throws off $100,000 of net income to you. That's hypothetical numbers, right?
Right.
Put in $100,000, I'm giving you $100,000 as net income that first year, right? And let's assume that that laundromat has some depreciation, let's say $25,000. So you have a net income of $75,000 coming in from investing in my laundromat franchise, correct?
Yeah.
So now what happens is, you may end up paying taxes if there's no other depreciation to offset that loss, offset that income. So what we're doing now is, let's say you put that entire $75,000 that I gave you as net income into a real estate deal, right? And that real estate deal throws off $75,000 worth of depreciation loss. So now what you're saying is the depreciation loss that the income that I had of $75,000 from owning this franchise gets offset by the depreciation that this property threw off of 75K. And really that $75,000 of income from franchise became tax-free.
Exactly.
Right.
That's the key.
Really the power of investing in assets that are increasing in value, but IRS allows you to depreciate. Right?
Correct. So let's make it a little more personalized now. Talking about medical professionals, a lot of us have shares in different medical enterprises or practices, right? That we get a certain amount of profits out of those participations in surgical centers, medical practices, and all this stuff. Would that be applicable if you take those profits, invest them in real estate, and get that depreciation work for you, and counteract the tax paid for that income?
Okay, perfect. Yes, you can. But the key is it has to be passive income.
Correct.
So you may have to restructure a few things to make sure that you fit that passive income bucket.
Yeah, and like Tom Woolwright said, in order to change your taxes, you need to change your facts.
Exactly.
Right?
Yes. I think what we want to make sure is that you're able to, you may have to think, you want to always think, how can you convert your active income to passive income? Not by lying, not by cheating, but through you want to talk to a professional CPA who can help you, and probably an attorney who can help you restructure some of those things.
Yes.
The income that happened to be active ends up becoming passive, right? That's really a step one. You may not even have to go through it, but if you do go through it, that's how I think about it.
Yeah. Yeah.
I think the bigger decision then is from that point is, okay, now I have $200,000 of passive income coming in. It's still taxable if you don't do something with it, right? You're
Correct.
still paying taxes on passive income. It's lower than the ordinary income, but you still end up paying taxes. But what we're trying to tell you is that there's a way available where you can zero out those taxes.
Right. And this is probably one of the biggest, I mean, it's probably the biggest expense of our lives, right?
Yeah.
Paying
Yeah, I
taxes.
think most people.
The most we can do is invest into this real estate deals and assets that can produce that kind of depreciation and paper loss to offset some of the taxes.
Right.
And you know, I wanted to give our listeners a kind of an overview of these points as being a passive investor in real estate syndications. And you know, I just want to make everybody aware that your podcast is one of the most wealthy information source for any kind of investments in real estate. So I would certainly advise everyone to check it out.
Thank you, Tudor.
It's called Migrate to Wealth.
Correct. And you are on one of the early episodes.
Yes. And I keep listening to it. You bring very good guests on and different topics that can be very educational.
Thank you, Tudor.
And also, you know, I would advise our listeners to check out my website, stellarmultifamily.com, for any kind of updates and newsletters and information. And I hope we get more questions from our investors, and you know, hopefully we'll keep doing this kind of questions and answers.
Yeah, I would love to. Always a pleasure to talk to you, Tudor.
Thank you very much, Saket, and hope you have good real estate journey from now on too.
Well, you too, my friend. All right, we're in together.
Thank you. Thank you.
Yep.
Take care.